Here's a very simple explanation on how you can use the universal life insurance contract. This first method here is based on a 35-year-old male putting in a little over $10,000 a year just to make sure that um, you're being responsible for your family. God forbid something happens to you. For the first 3 years, you have $1 million that only cost you $30,000 to pay into. Now, in that respect, it looks good. But if you're trying to use it for cash value or grow your money, it doesn't work as effectively as it could if you change a few parameters that we're going to show you here in this little next slide. So your money does grow, but it doesn't start until late in age. But if you want it to start growing sooner than that, then you're going to have to change a few parameters so that way it'll work for you. Now, the way to do that, a lot of agents are not trained on how to do this, but you'll notice right here in this next slide, we're using the same parameters, same $800, same time frame, 25 years. The only difference here is instead of paying for $1 million worth of life insurance up front, they're paying for the state minimum that the law will allow you to buy. So that way you see in the first 3 years you have way more money saved up than what you would buying just pure life insurance. Here you can grow you a very substantial death benefit just using your cash value plus the death benefit that they allowed you to that came with the policy. So this way you can still get the same gains, same etc., but your money grows a lot faster this way, and it still doesn't lapse. Now, like I said, if you wanted to use this money, in your retirement for, milk, cheese, eggs, expenses, and stuff like that, you're perfectly able to do that and not having to worry about paying any taxes. And in addition to that, no matter what goes on in the market, your principal you do not lose your principal. So that's a big bonus in utilizing the IUL this way. Now, how the banks and corporations use the IUL, they do what's called, they max it out. Now, this is an example of how they max it out, is they do put way more in here. But when the banks and corporations use life insurance, they use it for liquidity, safety, rate of return, lack of volatility, and inflation. So this allows them to grow chunks of tax-free money to use for working expense, business capital, real estate, etc., borrow from themselves, and still have a death benefit to boot. What other asset does this?